All right, so now we can hit up all of the important concepts from chapter 2. Once again, my expectation is kind of that you guys are reading through the books as we go through this. Hopefully you've gotten your book. If you haven't, just reach out to me. We will figure it out. So the first thing we really want to talk about here is the management cycle. Okay, we look at this big messy graph over here, and we'll kind of go through each one of these parts as we progress through this chapter. So the management cycle really consists of a few different phases. The first phase is the planning phase, then you've got the performing phase, and then finally the evaluating phase. Okay, so we'll go through each one of these in a little more detail now. So the planning phase, it's essential to all businesses. Okay, every business has to have a good planning phase. If they don't, everything kind of falls apart further down the line. So this phase really is essential to all businesses. You'll see that the most successful businesses spend a lot of resources in their planning phase, right? The better the plan, the better they can execute that plan, and the better their results are. So we have two levels of the planning phase. The first is the strategic level, and this really sets kind of the broad overall general goals and objectives for the company. This typically covers longer periods of time, like 5 to 10 years. So you'll have a 5-year strategic plan, a 10-year strategic plan. I've been a part, throughout my career, I've been a part of these planning processes for strategic planning. I was on a strategic reporting team that we reported out on the strategic plans and all kinds of stuff like that. So essentially the strategic plan is like, what kind of product do we sell? I mean, that's a very general, basic part of it, a very general, basic way to look at it, but that would be an example of a strategic plan. So the next one is the operating, okay? And this is where you accomplish those strategic goals, but it's in the short term. So it's typically going to be less than or equal to a year. The one thing to note is that it has to be compatible with the strategic plan. Okay, and so what I mean by that is that you can't say that you want to sell shoes in Boca Raton, Florida, but you don't have any brick and mortar stores in Boca Raton, Florida. You don't have any way of shipping those shoes to Boca Raton, Florida, right? You've got to make sure that your operating plan is compatible with your strategic plan. The objectives do need to be specific, obtainable, and measurable, right? So one of the worst things I've seen when working through strategic plans and strategic budgets with companies, particularly in the healthcare industry, it seems like they're very bad about this, is they set what I would consider to be unrealistic or unobtainable goals, right? So, hey, we want our revenue to be this percentage, or we want cash to be this percentage of our revenue. We want to increase our revenue by this amount. But, they just set these crazy goals, and then when it comes time at the end of the year to report out on meeting those goals, they've got to do some finagling around to make sure that they meet them. Whereas if you just set your goals and your planning to be specific, to be attainable, to be measurable at the get-go, you're going to have a lot easier time, right? So you don't want to set a goal like make a lot of money. That's not specific enough, right? You want to say, in the next 10 years, we want to have our yearly revenue be over $1 million. Okay, that's a little more specific. The next phase is the performing phase. Okay, so this is where we, as a company, complete the planned business process, right? So we've set out a strategic plan, we've set out an operational plan. Now we're going to perform that plan. Okay. In this instance, we have financing activities that come first. Remember, we talked about you have the 3 different types of activities: operating, financing, and investing. In this instance, we're going to have financing activities come first because we've got to generate that capital necessary to invest in the operations of the business. So the investment activities come second. That's when we're purchasing or leasing out operating infrastructure. Okay, so in this phase, we're going to use the accounting information systems, or the AIS, to kind of collect data, analyze the process. Is it a successful process? Is it not a successful process? Where can we make changes to make this process more successful in the future? Finally, we have the evaluation phase, or the evaluating phase, and this provides information to external and internal users about the performance of the company. So this is going to be like your reporting process, right? I've been a part of teams like this as well, where we're doing strategic reporting. We're reporting out and evaluating the process and the plan. Did it work? If it didn't work, where can we make it work? Okay. Typically, this is going to involve comparisons of actual results to budgeted or projected expectations. And like I mentioned earlier, this is where I saw most of the trouble come in, was at the end of that fiscal year when you're making a budget to actual comparison and you're doing that variance analysis. Was it a favorable variance? Was it an unfavorable variance? This is where a lot of the changes come. Typically, you'll see this just called budget to actual. So if you see the term budget to actual, or I say the term budget to actual, this is what I'm talking about. Comparing your budgeted or projected expectations to what actually happened. For this, we use our AIS to do two things. One is to evaluate the efficiency and effectiveness of the operating process. Those of you that have been in management classes, you're very familiar with that term, efficiency and effectiveness. You know that they're two separate things, but they go together hand in hand. And then we'll also use those results and those reports to start planning for the next iteration of the management cycle. Remember, here we're in that 1 year or less than 1 year portion of that strategic plan. So within these plans, we have the business processes. And these are a collection of activities that in the end are going to produce an output of value for the customer. We'll discuss the business and organization strategy, the operating process, capital resources process, and the performance measure and management process. So the business organization and strategy process. You've got to make sure that the strategy of the company fits the external environment. And what I mean by that is you have to look outside of the company and see what's working. You got to check out your environment. Is it what we call a certain environment? This is an environment that's known. Customers, products, advertising, all of these processes are kind of established. They don't change much. They're pretty static. And since these things are static, you can focus internally. You can turn that eye inside and look at what can we do to be more efficient in our operations. So you have what we call mechanistic structure. Okay, you tend to focus on the operations, the efficiency and effectiveness of your operations, because your external environment isn't going to change much. You don't have to worry too much about that. The other one is what we call the uncertain environment. And this is an environment that's pretty volatile. Your customers, your products, they change rapidly. Your approach, your strategy has to be very flexible. Okay, you've got to change on the fly. You've got to be willing to adapt. That's an uncertain external environment. You tend to have what we call an organic structure here. So your teams are going to be cross-functional, meaning your HR may provide some management duties. Your marketing team may provide some HR duties. So you're going to have cross-functional teams that are flexible and provide multiple functions. That allows your strategy to be flexible and change based on the market conditions. So the operating process, this is typically what we consider to be the profit-making activities of the business. So if we think back to chapter 1, when we talked about net income, that comes from revenue exceeding expenses in a specific period of time. You have greater revenue than you do expenses. Okay. So these operating processes include any of those processes that generate revenue. And you see I've got revenue here in parentheses. It's going to be things like marketing, sales, receivables, collections. You know, one thing that my wife has told me about her work is the reason her department doesn't get bonuses where other departments do is because they're not a revenue generating department, right? So it's not as easy to give them a bonus because they're not actually generating any revenue for the business. So these are the types of things that are included in that process. We have also the expenditures process. This expenditure, you'll see these terms in the parentheses are going to match up to that graph that we've looked at, right? And I'll flip back to it here in a minute and we can take a look at it. But it also includes the processes that incur the expenses or the expenditures portion. It's going to be purchases, HR, payments or payables. My wife is an assistant controller, so she works with payables and things like that. Purchases, the HR functions. So that's why I'm saying she doesn't really generate any revenue. Her department is just an expense. So it's not as easy for her bosses to justify giving that department a bonus. In manufacturing companies, it's also going to include that conversion process. We're converting like raw materials to work in process to finished goods that we're going to sell, right? So that's kind of the conversion process. And we'll talk about each of these in greater detail later on in the class. The final one is the capital resources, and this is but it involves the investing and financing activities of the company. So we talked about the operating activities, right? Those are the revenue and expense generating and incurring activities. Now we're going to talk about the investing and financing activities, or the capital resources. So investing activities are like purchase and sale of long-term assets, so property, plant, and equipment. If you remember, we talked about that in some of the prep videos. So property, plant, and equipment, those are all long-term assets. So the purchase and sale of those are going to be what we consider to be investing. The way I like to always describe it is kind of think about yourself as a farmer. If you were a farmer and you purchase a new tractor, that is a tractor, or that is a piece of equipment that is going to last you many, many years. It's going to help you generate resources for many, many years. So that is an investment back into your business. So just think of it that way. The investing activities are the purchase and sale of like long-term assets like PP&E. Your financing activities, on the other hand, are a little more self-descriptive, right? This is how we are obtaining the cash. How are we generating capital for our company? And we're doing that through obtaining cash from creditors. We may borrow money from the bank. We may sell bonds. We may sell shares of our company to shareholders, to people that are interested in buying ownership in our company. This is also money that is repaid. So an outflow, a financing outflow, would be paying money back to a creditor, paying off a note payable, paying a dividend to a shareholder as a financing activity. So those are kind of the different phases of our wheel that we looked at. If we want to go back, sorry, I'm flipping through this really quickly. You can see here the different pieces that we've talked about. Now we've hit all of these. I'm hoping that this makes a little more sense to us all now, since we've talked about it, right? Now we went through in great detail and discussed each of these. The final thing that I want to talk about here is internal controls. Okay, so internal controls we'll all refer to pretty frequently as IC, simply provide reasonable assurance. And I've got that term bolded on this slide for a reason. That's because in accounting, we never talk in absolutes. I can never absolutely assure you that we've met any of those objectives. I can never absolutely assure you that there's not a material misstatement somewhere on my financial statements, whether it's intentional or unintentional. Okay, so we provide reasonable assurance, something that a reasonable person would look at and accept as the truth. Okay, that's what we provide, is reasonable assurance. The IC, the internal controls, provide reasonable assurance that the company meets the following objectives: that we are effective and efficient with our operations, right? That's our income statement. We are reliably reporting our financials, so those are all four really of our financial statements. So what that means is that there's not what I keep calling a material misstatement. There's not a material error. Material being something that is large enough or significant enough that it would change your mind as an investor or creditor, right? So there's not material misstatement, whether it's intentional or unintentional. There's no fraud that we're aware of, right? We are telling the truest story that we possibly can, and we've had it looked at, and a third party agrees that we are. Okay? And then also that we're complying with all applicable laws and regulations, right? Because like we said earlier in chapter 1, when you're a corporation, there are a ton of laws and regulations that you have to abide by. So we have these internal controls to make sure that we're complying with laws and regulations. One of my jobs when I worked at the state auditor's office was to look through the federal compliance guidelines and set up testing for accounts that we felt maybe were not meeting those guidelines. So it's a document that is thousands of pages long. You can go on the federal government's website and pull it down and look at it if you'd like, but it's not terribly interesting. So one thing I'll note here is that having controls is not just a good idea, right? So even if you are a sole proprietor who doesn't trade publicly, it's a good idea to have these in place, right? You don't want to have a cashier that's stealing cash from you, right? You want to make sure that the cash you're taking in is the cash that you're reconciling at the end of the evening. So it's always a good idea to have controls in place. However, for publicly controlled corporations, Companies that sell their stock publicly, it's not just a good idea, it is the law. And the law that was written to make sure that this happens is the Sarbanes-Oxley Act. We'll call it SOX for short. Anytime you hear people talk about SOX, that's what they're talking about. Sarbanes-Oxley, they were two senators back in the late 90s, early 2000s that wrote this legislation because of some very significant frauds that were occurring. And some of the big CPA firms were a part of that. You can go ahead and you can look them up if you're interested. It's things like Enron, WorldCom, Tyco, that kind of thing. So we wrote this legislation was created, and it basically says that publicly held companies have to have their controls audited by CPAs, and that it is management's responsibility to maintain the following things: control environment, risk assessment, control activities, information and communication, and monitoring. Okay, if management, meaning your executive management and your board of directors, isn't complying with this, you can get in a lot of trouble, jail time even. So the control environment, regardless of kind of what this pyramid picture says, is really the foundation, right? You would almost think of it at the bottom, right? It's the foundation, the building block for the rest of the internal controls. But the reason it's at the top here is because it sets the tone at the top. And you'll hear me say that a lot, the tone at the top. That is basically, how does your management, how does the board of directors treat internal controls? How do they treat ethics and integrity within the company? Okay, so this is a way for management to demonstrate that they are committed to standards of conduct. So one way to think about it is, if your boss is taking $5 a day out of the register to go and buy himself snacks, it makes it easier for you to justify taking $2 a day out of the register to buy yourself a snack, right? Well, my boss is doing that. Okay, well, that's the justification, and you have to set the tone at the top. If they're not doing that, if they're following all procedures and guidelines, if they're following the internal control procedures, then the tone at the top is much better, and you've got less likelihood of theft, of abuse, of fraud, that kind of thing. So you really do, again, it's that tone at the top. You have to set that tone at the top. A lot of these controls are put there for mitigation and to mitigate fraud, abuse, misuse, and also to be proactive about it. Okay? Risk assessment is the process of identifying and analyzing the risks to the company and decide how you want to manage those risks. So again, this is kind of a management concept here, but a lot of companies conduct what we call a SWOT analysis. That's SWOT. So strengths, weaknesses, opportunities, threats. Okay. So they'll conduct a SWOT analysis to kind of help them understand the risks that are involved. So strengths would be like, what is the strength of your company? What do you do well? Weaknesses would be, what do we not do well? What can we improve on? Opportunities are, what opportunities are out there for us? Where can we expand to? What new things can we do? And then threats are just that. They're threats, both external and internal. Are there internal threats? Are there people that we feel, are not trustworthy within the corporation? Are there things that we are doing that we can improve on to make sure that we're mitigating and being proactive about our risks? Then you have control activities. And these literally are just the actions that result from the policies, the procedures that management has built in. So examples of this would be like the segregation of duties, making sure that you have locks on doors for offices, like here in Glass Hall, all the faculty offices lock, having key control on doors, on external doors, that kind of thing. Those are all control activities, right? Those are all physical control activities. The next one is the information and communication piece. That's pretty self-explanatory. It is exactly what it says. Are you communicating? Are you providing information? If you're not communicating this stuff, it isn't easy for your employees and for everybody in the company to follow these guidelines that you're setting forth, to really follow these internal controls. And finally, you have monitoring. And this is the process of oversight, process of supervision. It's assessing the quality of the controls that have been in place. You should be monitoring your internal controls pretty regularly. I would recommend doing internal audits of your internal controls to make sure that they're being followed. And when they're not, you need to make improvements and changes to those internal controls and to those policies. So that's really it for Chapter 2. I will put something out about a big control that I've seen a lot, and that's bank reconciliation. That'll be the next video that I put out for you guys. I will probably assign kind of an extra credit assignment for you guys if you'd like to complete a bank reconciliation. It won't be necessary, but I do believe we will have some, at least at a conceptual level, questions about bank reconciliation and internal controls on the exam.